Hey everybody, Boris House from BK Force. Welcome to our Forex weekly technicals for 4/28/502 of 2014. Where are the trades? And it's a really good question because it's been incredibly low volatility week. As a matter of fact, it's really been a very, very low volatility month this month. And nothing is more evident of that than look at this chart of euro dollar. Euro has effectively, and I've shown this before, but it just bears repeating because it is just unbelievable. I don't think in the 10 years that I've traded FX, we've had the kind of situation where we had now. Literally 50 points, one half of 1 penny range for full 2 weeks worth of trades. That kind of just absolute non-action is astounding. We've had that kind of low volatility in the yen for many, many months when the yen was in the 70s. But then, of course, yen broke out. And his yen has had more volatility than the euro lately. It's just astounding at how little movement there is both ways. We're basically capped 38.50. We do have enormous amount of event risk coming up, though. Of course, we have the NFPs this week, and then the week after that, we have the ECB meeting, and prior to that, we have the German inflation data. But I wonder if any of this event risk is really going to make a dent in the movement of currency, simply because the key assumption in the marketplace now is that nobody is doing anything, that the news is neither so horrible nor so great that either side is moving off its initial position, which is the Fed basically just keep on going with their taper but not necessarily moving towards a tightening policy, and the ECB refusing to move to a negative interest rate or a loosening policy. So we have this kind of a standoff. The market definitely is reflecting it, and it's very, very difficult to try to trade this morass. So if you're a range trader, it's been a great range trading construct because basically you sell 38.50s, you buy 38s, and you had a couple of touches both ways for the last couple of weeks. Clearly, this is going to break one way or the other. The question is just when. The key points of pain to the upside, of course, come 39, and then 39.50 would be the really big point of pain, because if you can clear that really puts us on track towards 40. But this is something that used to happen within a day, and it almost feels like it could take a year to move 150 points in the euro these days. In either case, those are the levels that I think, of course, the market will be focusing to the top side. To the bottom side, there's a whole host of support levels here from 38, 37.50, 3700, all the way down to the really 36.50. So it'll be interesting to see, certainly from this week's perspective, if you were just looking at this microstructure, the bullish case is stronger than the bearish case. The euro has tested the lows and come back up, and basically has held the lows and remains in a modest uptrend here, although 50 is the key level. I think if we can break towards the 75s and 80s, the move towards the 39s really becomes almost self-sustaining, simply because we've been so quagmired in these low levels. There's probably a tremendous amount of stops resident here that's going to just create a massive short covering squeeze. Very difficult to say which way we go, but volatility is mean reverting, and eventually we are going to revert to the mean. We'll just have to see how well it plays out in the euro. Story in the yen is a little more lively, not much, but a little more lively. And of course, we have, the yen is topped out at 102.50 and under some considerable pressure here because of the Ukraine crisis brewing. We'll have to see if there's any significant escalation of risk and escalation of tensions over the weekend. The yen kind of has been trading off of that, but since there hasn't been any military conflict, the yen sort of holds the 102s. We also have the BOJ meeting next week, and of course the really big event is going to be the NFPs. The problem with the bullish dollar yen case is that it's difficult to imagine either the Japanese side or the US side contributing much towards a bullish case. So on the Japanese side, it's the BOJ is very unlikely to increase its quantitative easing policy so soon. They may consider it 2 or 3 months down the road, but they tend to be very cautious. And I think at this point, they don't want to necessarily add to the monetary stock, even though, frankly, with with the sales tax increase and with the relatively tepid production and continuous trade balance deficits, there's no reason why they can't try to push the yen lower. But they are cautious, and they don't tend to not to make very assertive, aggressive moves. So therefore, the expectation off the BOJ conference is very, very muted. And then furthermore, the NFPs, nobody's really looking for a huge print here. We really would need to see a 250, maybe 275 print to give it a truly strong burst up and push us all the way out to possibly 103.50s. So the fundamental catalysts seem muted. The geopolitical risks seem pretty real. Having said this, though, this 101.50, very, very strong support level. And of course, the yen has found support here quite a lot. So even if we do have a nervousness at the beginning of the week, there's probably going to be buyers here underneath here for the time being. But a very serious unwind could definitely push us towards the 150 or the 100 level as we go forward. My apologies for the noise of New York City. So the other interesting thing is same kind of absolutely dead non-momentum trading has been infecting the pound as well. Although the data on the UK side continues to impress to the upside, the messages out of the BOE is that they're going to take it very, very slow. They're not going to be quick to jump and hike rates. And this week's BOE minutes revealed that fact that there was a wide variety of opinions, meaning that basically most MPC members essentially do not feel the time is ripe for any tightening just yet. And that's a capping cable at this very key 68.50 level. Now, if we have anti-dollar moves beginning of the week, I think we could clear the 68.50, but it's certainly been a huge, huge barrier. And the longer we fail to hold this, the longer we extend this topping formation, the likelier it is that we see a more severe correction to perhaps 67, 6600. Not too much data on the UK side, so it's really going to be all dollar driven as we go forward. But still, very much worth watching, simply because a failure here could just precipitate more of a corrective phase as everybody tries to bail out of the trade. Then on the Aussie side, we have found a little bit of support here at this ahead of 92.50, but it's modest. And certainly Aussie has really come off the 94 highs as the RBA pretty much communicated without fail that they're not going to. They really like to see the currency lower. Inflation threat is essentially non-existent in Australia, and therefore any kind of market expectations for perhaps tightening has kind of gone away. It looks like 92 is going to be the support level. We'll see if there's any potential downdraft towards that level as next week develops. That's going to be a more serious support level. You see how much more support there has been there prior. But Aussie clearly kind of in a longer term topping out formation may find a lot more support here. If you're bargain hunting, you certainly want to be buying 92, not necessarily here because it doesn't look like it's bottoming out just yet. But whatever rallies we have are probably going to be limited in nature. And Australia may begin to correct to a more serious correction towards 90 as the summer progresses. And then the Kiwi had a surprise sort of a move. What's interesting about Kiwi was we had an interest rate hike. We had a relatively hawkish statement from the RBNZ saying that, yes, they're concerned about the strength of the currency, but they're going to be very data dependent in their response to interest rates. New Zealand now yields 3%. It's a serious carry trade. And yet we had this very negative reaction to the news. Generally, when you have positive news, negative price reaction, you really want to pay attention to that. And the fact that this technical signal has sent us a reversal basically suggests that Kiwi is a sell anywhere up to 86.50, and that if we cross 86.50 and we close on that level, then all the shorts get negated. But for now, you're operating under the short assumption, and if you really sort of wanted to get a little more aggressive and press the case, you would wait until the lows, which is what, about 85.40 or so. The lows were broken to the downside, and then you could feel more confident that 85 and then 84.50 could be the test levels for Kiwi as we go forward. So definitely worth watching that trade as just an unwind trade going forward. Very little stuff going on in the crosses. That's why I'm spending much more time on the majors. Sorry, I forgot to cover the CAD. Let's talk about the CAD. So CAD Also, following very look at this incredibly tight formation. It's just incredible. The volatility, I think, over the last week. Yes, we've had Easter. Yes, we've had April. And generally, April tends to be kind of a pretty horrid month of trading in FX. But I don't think anybody expected literally no price action whatsoever in the currencies market. So the interesting thing about the dollar CAD is that yes, we've had this bounce back up to 110, but notice that one of the interesting things about dollar CAD is that every time we've had a bounce, we haven't really had much extension to the upside. This 112 definitely capped it as a double top, and if we fail here and start breaking towards the 109, that perhaps could be a little bit more CAD bullish. What's interesting here is that if CAD is kind of showing relative strength, then perhaps on the crosses here, the trades could be to the CAD side. So Kiwi CAD is another way to express Kiwi correction. Aussie CAD might be another way to express, and you can see Aussie CAD kind of really topping out at 103, expressing CAD relative strength here as we start to unwind a little bit more. Basically, if you believe that there is further more correction in the antipodeans, then the Canadian dollar could be the right way to trade it on a sort of a low risk, low volatility trade against that position. Other than that, very little else going on. The yen crosses, of course, came under pressure today because of dollar yen, but a lot of it is contingent. Where's my euro yen here? Here's euro yen. You can see it's a very, very minor. Nothing I think reflects this volatility stall better than the yen crosses, where you literally have, euro yen is, look at the normal ranges of euro yen, minimum of 175 points, and euro yen has been trapped in a 30-40 point range in trade. Pound yen was a little more to the downside, and pound yen actually looks a little more bearish in some ways. And this all goes back to the idea that the cable kind of corrects to the downside. So the interesting thing is that we have a stall in price, a huge amount of event risk, and the really big question next week is whether anything is gonna move us off these very, very short, narrow ranges. But as things set up right now, we're looking at topping out in the pound. We're looking at sort of a resolution one way or the other in the euro, and a possible further correction in Kiwi and the Aussie as the week sets up. Wish you guys the best of luck and the best of trading. Boris Schlossberg over and out.